Hello, everybody, and welcome to the monthly market memo for the month ending February 2025. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to walk through some of the key themes that were moving our markets with some key insights for the month of February, talking about stocks and bonds. And then at the end, let's jump into some of the more frequently asked questions we get from our investor audience from time to time. So without further delay, let's talk about stocks. Now, stocks did slow down for the month of February in the S&P 500, but there actually was some good rotation into some other diversifying asset classes like international stocks that I believe will allow this global bull market to continue. Now, the Magnificent Seven, otherwise known as a few of them are Nvidia and Apple, Amazon, some of those larger mega cap stocks have really been leading this bull market from the very beginning a couple years ago. But as those markets may continue, as those stocks may slow, which they did in February, you might want to look, and we've been looking for overseas stocks to pick up some of the slack. Now, what I'm showing here is the S&P 500, which was down for the month of February about 1.3%. Magnificent Seven stocks fell even more, down 8%. But if you look at those two lines above zero, those are some of those overseas stocks that we have added diversification benefits to, about 2.5% for developed international stocks, mainly Europe, and then emerging market stocks were up for the month of February as well, up about 0.5%. And really, this hasn't just been, 1 month. It's been a continuing trend for the better part of 3 to 4 months, which is something very encouraging for us to look at. As the S&P 500 is down about 1% over the last 3 months, and then overseas stocks around 3.5% or so, and emerging market stocks up 1. So something very encouraging to see. Finally, some other areas of the markets are starting to participate. We definitely have diversification of your account overseas to some of these markets, and something we'll continue to watch very closely to determine if we need to add to some of these areas. Now let's jump gears to bonds. Some of the reasons we saw a stock pullback, a little bit of a pullback, if you will, in February was weakening surveys across consumers, across companies, and then some data around jobless claims picking up, which did weigh on stocks for February. Now, what we were looking at here is what's basically been garnering a lot of headlines is the government cuts around the DC, Virginia, Maryland area, where a lot of these, government employees likely live. And we've seen unemployment claims, something I'm watching very closely, unemployment claims actually rise for the better part of a few months here in these areas. Now, nothing to be alarmed yet, if you will, but that did allow stocks to move lower, but also did move bonds higher. So this is something that, we are very encouraged to see. If we see a little bit of a pullback in stocks, bonds typically pick up the slack. They don't always, but it was something we did see in February, as I'm showing here in the chart on the right-hand side. If you just look at kind of the latter part of that time period towards the end of February, stocks fell and ended the month down about 1.5%, as I mentioned in the previous slide, but also bonds and longer term bonds, 20+ year maturity treasuries, were up almost 6%. And then core bonds, which are more what we have diversification to in your account, would be up a little over 2%. This is a very big month for bonds. That's a good month, 2%. Usually only happens 5% or so of the time you get a 2% increase in bonds for the month. So very encouraging to see that bonds are acting as a hedge again in case any slowdown perceived with these surveys and hard data that came out for February. Something we'll keep a close eye on still as well, but bonds are adding diversification benefits to your account. And then finally, I wanted to talk a little bit about one of the questions we get often here, and that's Bitcoin, right? Or cryptocurrencies, but primarily Bitcoin is the largest. It has been gaining traction as there are more investable ways to access this, mainly with the exchange traded funds. But we do believe risks still remain. And one of those biggest risks is the asset is extremely volatile, which can cause a really buy high, which you don't want to do, and sell low, which you don't want to do, reaction, right? People want to get in at the very top, and then they see how volatile it is. They get out at the very bottom, not a recipe for success. And what I'm showing here is the red line is the daily price movements of Bitcoin. You can see it's just extremely volatile. The blue line is the daily price movements, same period of time for the S&P 500. So on the very worst day over the last year or in a couple months was in August of last year, where the S&P was down about 3.5%, a big move. However, on that same day, Bitcoin was down over 21% in a single day. It's a very volatile asset class, and you can just see it go up and down a lot. Now, over time, it can add value, but this type of behavior really can cause anxiety amongst investors, and something that we need to pay attention to before we would ever think about including it in the portfolio. Now, in fact, if I looked at this and you see on the extremes, if it's over 2% positive or greater than 2% negative, that happens a lot for Bitcoin. 50% of the time almost, it has those extreme days where it's either plus or minus 2%. The S&P 500 again, for this time period, only about 3%, a much more still volatile asset class, right? But not even near what Bitcoin is. And this translates also into the risk of loss, which can be very high. Drawdowns of 20% or more are very frequent, as I'm showing here in this chart. You see that blue line again is Bitcoin, red line is S&P 500, and I highlighted about that 20% quote unquote bear market of what you could assume would be, and the Bitcoin flashes quite frequently greater than a 20% loss. Currently, Bitcoin is in another 20% drawdown. So it's something that can cause a lot of daily anxiety, and the drawdowns are much deeper compared to stocks. Now, why is that? Lastly, it's an area that really has no intrinsic value, meaning it has no yield and it has no earnings, and therefore it has no cash flow. Something that I believe are very important to consider to make an investment in, and to have it in a portfolio, it'd really have to hit those two boxes for us. So on the right-hand side of this chart, you see the S&P yields about 1.2%. Historical earnings growth are near 6% over the last 5 or so years per year. Bitcoin, 0 and 0, right? So it's a very volatile asset class. The drawdowns are very deep, and there is no intrinsic value. And for that reasons, we don't include it in our portfolios. I won't say it's something that we would never include in our portfolios, of course, but for now, these areas just can cause our investors too much anxiety for an investment to have. So with that, I'd like to leave you there. We'll talk to you in March. Thank you again for watching. We approach the management of your complete financial landscape very seriously. As a trusted steward, advocate, and confidant, we are completely committed to you. Please stay connected with us. View us on our website. You can always reach out to your financial advisor, email us. I'm always available, of course, as the Chief Investment Officer, and we hope you have a great start to the spring. Thanks again, everybody. Take care now.